Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering the topic that one of my subscribers left on my channel, and that is he had said that a few weeks ago he had started to buy AT&T and the dividend was at $1.96. It recently changed to $2 and he wanted me to help him understand the reason behind that. So in today's topic, we're going to be covering why do stocks raise their dividends. So I went out there, I got a nice little whiteboard here. I have my black marker, my blue marker, and we're going to go ahead and cover that topic today. So if you are brand new to my channel, I do make stock market, financial, and investment videos weekly. So do consider subscribing for future financial videos. It's 100% free. So when a company earns profits, there are lots of things they can do with the money. It can hold on to the profits as a cash balance. Apple is a great example of this. It can spend that cash buying back its own stock. Delta did this in 2017. They had a lot of shares outstanding. They used some of their earnings to buy back some of their stock. Less shares outstanding means that their net profits divide into less shares outstanding, which increases their earnings per share. They also give employees raises or bonuses. So with the tax reform, AT&T, Comcast, CenturyLink, they announced they were giving a lot of their employees raises and bonuses of like $1,000. So they can also pay that cash out as a dividend to their shareholders. And it can acquire other companies. Amazon is a great example of it acquiring other companies. It recently bought Whole Foods, and it was in the news as someone's prediction that they'll buy Target. I don't think that's going to happen. So, which companies pay dividends? I have three stocks here. I have Amazon, Microsoft, and Nvidia. Of these three, can you quickly tell which ones pay dividends? This is just off Google. If you look down here at the bottom, you'll see the dividend yield. That's a very good indicator that the stock pays a dividend. Amazon doesn't have any dividend yield. Amazon does not pay dividends. Many people like to invest in non-dividend stocks because they're growth stocks. So in this example, I wanted to display these three because here's Amazon for the year, had an increase of 59.04. Here's Microsoft, had an increase of 38.6. Yes, Amazon did beat Microsoft. But here's the video here. It pays a dividend of 0.28% yield, and they had a 103.53% increase in 2017. That's almost more than double Amazon. So it doesn't matter if you like to not invest in dividend stocks because you feel that they don't appreciate as much. You need to go out there and search for your companies. I invest in straight dividend stocks because I like to get paid as well as I like to have capital appreciation. Four good examples of growing stocks that pay dividends are Nvidia, Activision Blizzard, Apple, Starbucks. They all have a very low dividend yield, I believe 2% or lower, and they have very nice growth for the year, sometimes beating a lot of these other growth companies that are considered growth that have very high price comparison to their earnings. You can see that Microsoft sitting at 29.21, Nvidia is sitting at a 56.16, whereas Amazon here is sitting at a 303.95. So it's trading at a very high price in comparison to its earnings. In the example that I was given in the comments, they had purchased AT&T. So that's what we're going to be taking a look at. And this information is pulled from dividend.com. So in this example, we have the dividend yield, which is 5.31%. So how do we get the dividend yield? Well, that's pretty easy. I'm going to show you. We take the annualized payout. They pay out $2 per share, and they're currently priced at $37.65. We multiply this number by 100. Boy, I cannot do my math here. It was 2.00 divided by 37.65. That gets us that decimal number. We multiply it by 100, and we get 5.31. That's our dividend yield. Now, the annualized payout, they announce it every quarter normally. If you sit in and listen to the earnings calls, they'll go over their earnings. They'll declare their dividend for the upcoming quarter. And it's, a lot of companies, They will either increase their dividend per year, they may increase their dividend every 2 years, they may retract their dividend, such as General Electric has done. They cut their dividend in half, and that sent their shareholders flying for the wall. So their payout ratio is 68.5. How do we get their payout ratio? You take out how much they're paying per share, which is $2, and you divide that by the current earnings per share, which is 2.92. And we get a decimal. We multiply it again by 100, and we get the payout ratio of 68.49. And this company, AT&T, has had dividend growth for the last 33 years, since 1985. That means if you had purchased the stock in 1985 and held it until now, they would have raised your dividend year after year after year after year for 33 years. That is quite a while. There's lots of stocks out there that have had dividend growth for 30 years or more. So how do we get the earnings per share, or what is the earnings per share? Essentially, it's the net income divided by the shares outstanding. So you can inflate your earnings per share by stock buybacks, which would cause your shares outstanding to go down. And if we did the quick math here, and we take their net income here, it shows the diluted earnings per share right here, 2.08. So if we do 12.85 divided by 12.85 divided by 6.14 equals 2.09. So yeah, very close, 2.08, 2.09. It changes from quarter to quarter. It becomes a 12-month average. I forgot what it's called. It's like TTM. I forgot the abbreviation. But if I bring up my Market Pro, which is from Merrill Edge, I can see that the estimated for the fiscal year, or for the current year forward, is 2.91. The next forward year is 2.97, and then the next two forward years is 2.96. So they are expected to grow by quite a bit earnings in the following year or upcoming years. So this is a great indicator. Next, we want to take a look at their dividend history. I like to see how much they increase their dividend. What's their dividend growth like? So we can see here that in 2016, they were paying out 48 cents per share. To end of 2016, they increased it to 49 cents per share. 2017, they recently, again in a year, increased it to 50 cents, which is, if you multiply each of these by 4, you're going to get $1.92, $1.96, and $2 per share. So let's do some quick math. 2016, they were paying out 48 cents. 2017, they were paying out 49 cents. How do we get the dividend growth? So the current 2018, they're paying 50 cents per share, or 50 cents per share per quarter. We take 0.50, we subtract the original amount that they paid out, which is 0.49. We get the decimal of 0.01. We divide that by the original amount that they were paying out. We get a decimal of 0.02. And we multiply that by 100, and we're going to get our percent increase, which is 2% increase between 2017 to 2018. That's pretty consistent with AT&T. There are companies out there that increase their dividends to, say, 60 cents from 50 cents. And if we do that, do the math there, that's an increase of over, of 20%. So I like to see dividend increases between 5 to 8%. I think is healthy, because if you do the rule of 72, so if a company, 72 is a goal, look up the rule of 72. I don't believe I have any of these videos, but if they have a dividend increase that's pretty consistent of around 7%, and we divide 72 by 7, we can expect that our original investment, after around 10 years, just off our original investment, the dividend would increase, from the times that they increase their dividend payout every single year by 7%, at year 10, based off our original investment, we would now get paid double what we initially were getting paid when we initially invested in that company. So if we were getting $100 in dividends, we're now getting $200 in dividends for the year. If we were getting $500 in dividends, we're now getting $1,000 in dividends over the course of 10 years. And of course, with those dividends, you're going to be buying more shares, and this is going to compound year after year after year. So let's do some quick, historical math. So 2016, say you purchased some shares. We had $1,000 in 2016. We purchased some shares at $36.50. That is 27 shares. So 27 by 36.50. We put in $985.50 into the stock market. We had a bonus that year of $1,000, so we put $985.50 into the stock market. 2016, they were paying out 48 cents per share, or $1.92 for the year. We had 27 shares. That's roughly $12.96 per quarter, or $51.84 yearly. Now, if you're paid out a dividend, you can reinvest that maybe as a partial share, or if you enable DRIP, the dividend reinvestment program, you could take that $12.96, reinvest it back into a partial share of AT&T, and eventually toward the end of the year, you would probably end up with around $52, $53 for the full amount, just off the compounding. That was with our money that we had left over in our account, we were able to purchase 2 additional shares. In 2017, they increased the dividend to 49 cents. We now have 29 shares. They pay out $1.96 per year for each share. That's roughly $14.21 per quarter. Again, we're reinvesting it quarter to quarter. That ends up being about $56 to $58 for the yearly. We buy an additional 2 more shares with the dividends. We reinvest those dividends. 2018 rolls around, we're getting paid out 50 cents per share, or $2 for the year, and now we're sitting at 31 shares going into 2018. That's $15.50 for the quarter, or roughly $62 to $65 for the year, depending on, we're reinvesting those dividends quarter to quarter, buying those partial shares, or just doing DRIP, and it's reinvesting into the company. Now, the stock is currently priced at $37.65. That is right now, today. We buy 2 more shares with the dividends ending in 2018. Now, at the very end of 2018, over the course of 3 years, we've made, if we add these numbers up right here, we made $170.68 in dividends. That's money that was paid out to us. It's a qualified dividend, which means that it gets taxed at a much lower tax bracket at either 15, or I believe it's 20, 15, or no tax. I think it's 15%. If you fall into the 15% tax bracket, then you don't pay any taxes on your long-term capital gains or your qualified dividends. So I would look into this. If you are in the 20-25% tax bracket, you may want to invest in your 401k to bring yourself into a lower tax bracket, which would then you wouldn't have to pay just talk with your tax accountant. I'm not a tax accountant. Anyways, we're sitting at 33 shares now. After 3 years, we started with 27. We were able to reinvest and buy more over the course of the year. Over the course of 3 years, we increased our shares by 6. We multiply that by the current stock price, $37.65. That gives us the total equity of $1,242.45, or roughly $256.95 in capital gains. While that might not seem like much, we were also paid out $170.68. That's $427.63 that we made off our initial investment of $985.50 over the course of 3 years. Now, AT&T, it's not a growth stock. There are tons of growth stocks out there. Imagine if you had invested in Nvidia or Microsoft or Apple. So this is a great example because this is a pretty solid company. It doesn't have a lot of fluctuation. You buy the dips, you hold more shares. You buy the dips, you continue to hold your shares. Eventually, they're going to be paying you out in the long term those dividends, and that's very nice income right there. So that is it for this video. Hopefully I was able to cover the topic of why do companies increase their dividends. Because they have money, they want to invest in their shareholders. going into a recession, who do you think is more likely to sell their stock? Someone that's invested in a growth company that has a humongous price to earnings that doesn't pay a dividend? Do you think investors will sell that stock if they're not getting anything from it? They're losing money, they're not making anything such as dividends? Or do you think investors are more likely to hold, say, AT&T? It may drop by a few, percentage. It may drop by 10, 15, 20%, but your dividends are buying more shares at a cheaper price. You're averaging down. They're consistently increasing their dividend. They're not cutting their dividend during recession periods. No, yeah, exactly. Investors are going to be more likely to hold on to dividend stocks because they're going to get paid that dividend. And you want to do your research. You don't want to invest in any dividend stock. You want to do your research to make sure that you're investing in dividend stocks that are able to withstand a downturn in the market. They have had historical increases in their dividends. Look for stocks such as AT&T, Procter & Gamble, Johnson & Johnson, Hormel Foods, ADP, AT&T. I'm sorry, there's so many stocks out there. Go ahead and use dividend.com if you'd like. I have a bunch of other resources on my website that I use for researching dividend stocks. So that is it for this video. If you have enjoyed the video, remember to hit the like button. If you are brand new to my channel or a recurring viewer and you have not yet subscribed, hit the subscribe button. It does me a huge favor by doing it, and I really appreciate you guys subscribing to my channel. It's it's great. If you have any questions or want to say hello, if you want to leave a comment, go ahead and do that. If you have any questions, leave in the comments below. I always go ahead, I'm going to start making a lot of videos over comments that are left below by my subscribers and viewers. And again, thank you for watching. I will see you next time. Have a great day. Bye.